Welcome all. This is Vidya, and I'm joined by Aarti Krishnan and Bhavna Acharya. Interesting times, folks. And today we are going to discuss about the latest amendment made in the finance bill and also passed in the Lok Sabha in a matter of a day. Um, so we are going to discuss about what this means for your debt mutual fund investments. We're also going to discuss about what you're going to do to manage this. We are going to have a much more detailed writing on this soon, in the coming week, and I hope most of you will be able to, read and benefit about with it. But let's make a start now without wasting time. I request Bhavna to kind of give a brief on what's just happened and how it's going to impact us.
Okay. So thanks everyone for coming. Let's just very quickly go over what the changes are because I'm sure most of you have read it already. But going forward from now, from April 1st, mutual fund taxation will be based on three different groups. Okay. The first group is funds where the equity allocation is more than 65%. Here there is no change because they're all equity funds. Longer than 1 year is 12 months and taxed at 10%. With your 1 lakh exemption and all that. The second lot is your 35 to 65% funds which have 35 to 65% in equity. Now, this also is not seeing any change because short term is less than 3 years, long term is more than 3 years, you have indexation benefit. Now, of the mutual fund categories that there are, the ones that will most likely, come in this bucket is primarily like the hybrid, multi-asset category, because these are the ones that invest across equity, debt, and commodities like gold and all of that. So it's mostly only these multi-asset allocation funds that are going to come between this 35-65% bucket. The tax here is actually not changed from what it was earlier. They were still doing that. It's just that now most likely, even if these funds say that they can go 0 to 100% equity, they're most likely to keep it above 35% in order to comply with this long-term, short-term rule. So the biggest set of funds that are going to be affected by this new tax rule are funds where equity allocation is less than 35%. Now, of all the category, all debt fund categories will come under this. So whether it's liquid or corporate bond or short term, medium term, whichever one it is, including debt index funds, all of them will now come under the new tax rule where there is no concept of long term capital gains or indexation. Everything will be taxed at your slab rate and considered short term. Outside of debt funds, the other categories will be conservative hybrid funds because by mandate they cannot go more than 25% in equity. Then you have international funds because they not domestic equity, right? Then you have gold funds, you have all fund of funds, and you have these solution oriented funds that are either purely debt or which are mostly debt. So like your retirement funds or your children's funds and those kind of solution oriented funds will also, depending on their allocation, will come under this new rule of if the equity is less than 35%, they will be treated as short term and added to your tax slab. So that is only the categories that are seeing an impact. Now, when you consider the tax impact and what you should be doing with your investments, one thing you should remember is that the new rules affect only your long-term debt holdings, right? For your short-term goals, which is up to 3 years, like 1 year, 2 years, 3 years. For these, your approach to debt funds should be the same. It will be the same because there is no change. Even now, short-term gains are taxed at 20% with indexation, without indexation. Going forward, also, it's going to be the same thing. So when it comes to your categories like money market, low duration, ultra short, short duration, for all these, where you are using these to meet short-term goals, your approach still remains the same. So you need to weigh it against the other options that there are. And if you look at these categories of debt funds, right, their current YTMs are anywhere above 7.5, 7.7%. So if you worry about all debt funds and bracket them all together saying that they're, the tax treatment is unfavorable, It's not really entirely correct because the short term still remains the same. Where the maximum impact is going to be felt is only in the long term. So there, there are different ways to approach it, which is what we'll be discussing further on. But briefly, this is what the tax changes are going to be. So if that is clear,
Right.
then we can, move on from here.
Right, Bhavna, thanks. Before we get into details on what exactly the tax impact is, let's take a step back and understand these sudden changes that have come about. It has, kind of taken not just the industry, not the investors alone, but the industry also by surprise. So I'd like, Aarti to kind of give her views on, what's the direction, why has this happened. Oftentimes we don't ask this question why with the income tax, but still, and what's the direction that we are seeing, Aarti?
Right, right. So after this move has come about, I have heard this question asked even on social media: Is the government anti-mutual fund? Why doesn't it want to develop the bond market? Isn't the bond market in India very underdeveloped? And is this not a bad move for that? And so on. But from what I have gauged, tracking this government's tax changes over the last 8 years or so, I feel that the only objective actually to these tax changes, the purpose behind it is to merely plug any arbitrage that exists. So the moment the finance ministry or the CBDT find that one particular vehicle is taxed a little less than another vehicle and people are therefore moving to that based on the tax arbitrage, they simply want to plug that. Now, with the previous regime, perhaps UPA, there was a certain feeling that they are equity friendly and therefore that's why they favored equity. And so people think that even with these moves that has happened recently, there is a certain, you have to read some broad policy signal from it. I strongly feel that there is no macro signal, etc., that is being tried through these moves. In fact, if you look at the taxation moves in the last 2-3 budgets, the only thing that comes through is wherever they are finding people or people from a slightly affluent class enjoying additional tax breaks, they are trying to plug it. So last year there was a lot of furor after they said that if you contribute more than 2.5 lakh to the EPF in a particular year, the interest on that will not be tax free. There was also a lot of ruckus when they said that equity LTCG will not be zero tax. We will begin to tax it. This year there was ruckus when the budget announced that high value insurance come investment products, like when you pay more than 5 lakh in premium, the maturity proceeds will not be exempted. So these are all different asset classes. So without any partiality or favor, basically they are trying to look at any asset class or any investment instrument which is actually used by HNIs or affluent people, and if there is a certain concessional tax regime enjoyed there, they are trying to plug it. So this also is, I think this debt fund taxation also is part of that. Of course, some people may say that debt funds are also bought by retail investors, but if you look at the data, I think the majority of are HNIs, and perhaps the government has gone by that, is what I would say. So I would urge people to also stop worrying too much about why these changes are happening, why is the government so unfair, etc., and simply move on and look forward as to how these things can be managed and how best can you reorder your investments in order to earn better returns, tax or no tax.
Thanks for that, Aarti. I would second Aarti's, last point that rather than do, an analysis which would only lead to a paralysis of, why this is being done and, what should we be. Let's just focus on what you can do with your investments, where your investments are right now, how are they going to be taxed, and is there anything that you can do to kind of stay tax efficient reasonably, but very importantly, look for higher returns. But before we move to that, I just want to bring to your notice how exactly this, this change in this, taxation for debt, mutual funds, international funds, and gold funds are going to work in terms of tax outflow for you. So I did, quick calculation on, for people in multiple tax slabs. Okay, so first, the good news is actually it's not very terrible if this income is moved to your regular income and taxed, provided you remain in the same slab, right? If you get what I mean. I mean, supposing you're in a tax slab of say less than 10 lakh, right? Somewhere around under 10 lakh, and this income added now also keeps you under 10 lakh. Your total tax outflow as a result of this income getting taxed under your regular slab rate could be even as low as 4%. I mean, the increased tax outflow. Please remember that. See, when most of us talk, if we keep saying, if you're in the 20% tax bracket, this income will be taxed at 20%. If you're in the 30% tax bracket, yes, that's true. But remember, we are at a slab-based, taxability, kind of that's how it works for us. So your marginal rate of tax is never the 20% or the 30% in reality, right? So if going by those slabs, if you look at the additional tax outgo, it could be even as low as 3 to 4%, right? And if this is also a very important point, if this additional income pushes you to a new slab rate, your tax outgo jumps significantly. And I reckon the government is probably counting on that kind of, edge cases to move to the next slab to give them some additional revenue from taxes. For example, if this pushes somebody to the, I'm just taking examples here. If you already, had some debt investments, or you're making debt investments from April 1st, and after 3 years, it grows by say 8.5%, and you have long-term capital gains of around 2.5 or a little more. This might 2.5 lakhs or more. This might push somebody in a 10 lakh slab to the next slab. And in those cases, under the old regime, your jump in outflow of taxes could be 15 to 20% also. Again, it depends. Everything depends on what this investment has yielded for you, what tax slab you are in, and very importantly, whether you're going to the new slab or the new old slab. For example, what we found interesting is in the new slab, even if you move to the next, kind of slab, because of this income being added to your total income, it is interesting to know, because those slabs are more graded. They are not sharp increases. Your cash outflow, your total tax outflow may be less. In this case, for example, where I did this under 10 lakh and I had about 2.5 lakhs of, long-term capital gain, under the old regime, my tax outgo was 17% more. And under the new regime, my tax outflow was only 9% more. So this is also very important. These are things where I need to illustrate to be able to explain to you better, and I'm hoping to do it in the coming week. But this is very important for you. So when you plan even, your sale of investments made post, if you, make investments post 1st April, which you will if you consider asset allocation as a serious and important thing in your portfolio, and we do think it is, you will also have to plan your taxes. You have to be very conscious of the fact that whether this is going to, any redemption that you made, it is going to make you will push you to the next slab level. And how can you, kind of see how you can kind of postpone it, or, there are ways to do it, which we will discuss, of course, again. But this is a very important thing. So just two, takeaways from this. One, your tax outgo is not like huge or significant. There is definitely a tax outgo, whichever way you look at it. But it can be low also if you're in the same slab rate. If this income pushes you to the next slab rate, that is when your tax outgo significantly goes up. 3, it does appear that even if you're pushed to a next slab rate, the new tax regime might actually help contain it to some extent rather than the old tax regime, because of the way the slabs are. There are totally slicks, the nil exempt plus 5 in the new tax regime. So it's a very graded approach. So your rates are kind of not sharp, they don't move up sharply. To that extent, your cash outflow in terms of taxes will be lower. So this is just factual things, this is what it is. And we need to kind of see how we can manage it. Like I said, if you're going to move to the next tax slab, is there anything that you can do to kind of plan even your redemptions. If some of you are used to doing tax harvesting in equity, that's something that we might want to look at here also. We'll discuss again, like I said, these liquor illustrations, and we'll give you some examples later on in the upcoming week. But this is the thing. You don't need to be deeply worried if you are making small gains and it's not shifting your slab. Yes, 3 to 4% or 7% outgo, it's maximum. It's manageable, but depends again on the quantum of the sale that you make from your mutual funds. Now, having said that, what sort of funds, should I use? How do I use? What do I do with my existing investments? Are some of the questions that many of you had asked. And I'd like Bhavna to kind of explain that.
Yeah, so when you look at your funds, there are two aspects. Now first is your existing investments. Now your existing investments, if we read the rule the way it is, whatever you've invested in up to March 31st is going to continue with the current tax system. So your long-term gains will be there, your your indexation will be there. So your current investments really are not going to be affected here. So don't worry about investments you've made so far. You can continue, and you should be ideally staying invested in these funds. At whatever time you redeem, whether it's this year or next year or 10 years from now, it will still apply, right? If you have some surplus, what you can do is to invest in these debt funds to make most of this very tiny 5-day window that you have. If you have any surplus, you can invest in these debt funds. You can invest in target maturity funds if you want to do that lock-in, but otherwise, your existing debt funds, you can simply add it there instead of adding to equity, because equity you can add next year also when you have your surplus. So that is as far as your existing investments go. Now, in terms of fresh investments, there are different ways to approach it and look at it. Okay. Now, before you even consider all of that, the one thing you should absolutely avoid doing is to tinker with your asset allocation simply because of the taxes. So, just because now you don't have that indexation benefit for debt funds anymore doesn't mean that you completely reduce debt in your portfolio and go all equity, because that is completely throwing your asset allocation out. It is taking your risk to unmanageable levels, and that's not something you should be doing. So don't make asset allocation decisions based on taxation, right? Debt has a role to play in your portfolio. You need debt. It's just that now with the new tax rules, there are different options with which you can manage that debt portion. So far, it was debt funds that offered the best in terms of taxation, but going forward, there will be multiple other options that you can use. We'll cover some of it now, but we'll also write more about in detail in the coming week. Then the other thing that many of you are wondering is these hybrid funds. Now, of the hybrid funds, you take arbitrage funds. Arbitrage funds, no way are they suitable for your long-term holdings, because sometimes they don't even beat liquid funds, leave alone beat any other category of debt funds. So arbitrage funds for long-term portfolio is absolutely not necessary. You'll be taking a return penalty instead of taking a tax penalty, right? It's not really desirable. Then, which are the other ones would be your equity savings funds, which are lower risk than pure equity, yes, but they are still not a debt fund substitute. Okay, you can shift maybe a little part of your allocation there in your longer term portfolios, but they still have some equity exposure. They are still volatile. They can still deliver losses in periods of 1 year or a little more than that. And that loss doesn't have to be low. It can be as much as 11, 12% and all that. So it's not zero risk. It is not a pure debt fund substitute. So don't push immediately into, because equity savings funds have equity taxation, I should be putting more in that. That is something that you will hear. That is something that may be pushed to you, but don't really fall for that. The other category is balanced advantage. Now, balanced advantage is even more of even less of a debt fund substitute than equity savings funds would be, because at least equity savings funds, they tend to hedge much more than they leave it unhedged. But balanced advantage they vary wildly. So at times they can be even similar to aggressive equity, hybrid aggressive funds, which, they can be far higher risk than you would expect it to be. And you have no control over when that fund is going to increase hedging, when it's going to reduce hedging, and all of that. So again, while you can substitute part of your debt allocation, don't substitute the entire thing. Okay, if you take just the returns of all these funds and compare it to your corporate bond funds or gilt funds, the returns are fairly similar, or in some cases, only balanced advantage would be better by, like, say, a couple of percentage points or something. But otherwise, they return similarly, but they are not really debt, but they are far more volatile, which does not make them good substitutes. Okay, so don't get into throwing your debt funds out entirely in favor of these hybrid funds. You can have some allocation here. You can shift some allocation here, but start looking out for more debt options. So your categories like corporate bond funds, gilt funds, and all of those, while you have that accrual return coming in, you can also make higher returns during rate rallies. When the bond price rallies, you can make much higher returns than if you time it right, if you manage it right. You have the potential to make a lot more returns even in your normal corporate bond or gilt or constant maturity, all those kinds of categories. So it's not entirely without return potential. Then so that is for debt funds. Now outside of debt funds also, you have other options like bonds and all that. I think Aarti has a lot more to say on that. Aarti?
Yes, so far this taxation was a key reason why people, instead of directly investing in, say, listed NCDs or privately placed NCDs or even G-SECs, they used to go to the mutual fund route. The taxation was a big reason to do this. But now, with this indexation benefit removed, I think it is time to take a serious look at directly investing in listed NCDs, on which only 10% taxation is there after 1 year. LTCG is there, or even unlisted privately placed NCDs, the taxation is 20%. So that's also attractive. And in fact, of late, investing in these unlisted, etc., or listed has become easier with so many bond platforms giving you the data and giving you the means to actually participate. SEBI has also lowered the ticket size from which used to be prohibitive at 10 lakhs, and now it's become accessible to investors. And if people don't have this RBI retail direct account, I strongly recommend they open it, because I opened the account about 6 months ago, and I've been investing through it. Usually there's this belief that if it's a government platform, it will be glitchy and it won't be smooth, etc. But actually, I found it to be an excellent platform, and through that you can participate in the primary auctions of treasury bills, government securities, and state development loans. People think participating in auctions is a very tricky thing, and you need to be very knowledgeable. It's nothing of the sort. Actually, for example, recently you had a situation where a 364-day table was giving you a yield of 7.3% or so. So you just have to click on the platform, bid, and you will get the allotment. Allotment is assured. So I think these options are very much there for you now. What do you gain by investing directly instead of going through mutual funds? Well, if the fund has a significant TER, you can actually avoid that by going directly. And yes, it needs a slightly careful approach in terms of what kinds of issuers you pick and the extent of allocation you make to each instrument. But I think we plan to write a lot more in PrimeInvestor about these offerings. So do stay tuned in. Of course, the other slightly unsuspected investment vehicle which has become, I think, attractive now is the corporate bond and government bond options of the NPS. So if you're looking for long-term retirement allocations, this is also an option you have to look at seriously, because now the final maturity proceeds from NPS is actually 60% has been exempted and the other 40% also has been. So you get tax-free maturity proceeds. Of course, the compulsory annuity that you have to buy with 40% that gets taxed. But these are all some of the options that have also sort of opened up because of this change on mutual funds.
Right, Aarti. So, from what Bhavna and Aarti, have said, I would, kind of sum up that our view at Prime Investor would be that don't. This would be a time when both AMCs and distributors would go overboard, and it's easier, trust me, to sell hybrid funds. Right? They will go gung-ho on hybrid funds, and it is possible that they sell hybrid funds that are most unsuitable for your requirement or your time frame. Please be very careful about what you choose. There were, a few years ago when balanced advantage funds came into being, they were sold as regular income options. Let's not forget that, it's just 3 or 4 years ago. And they were giving regular dividends until the time when the market hit and the dividends dried up and that option went away, the monthly dividend options as they were called. And of course, the dividend taxation also kind of helped kill it. But please remember, not all hybrid funds will suit you. From Bhavna's summary, it is evident, and we have data for that equity savings, because of its high edging, can contain downside somewhat better, but it cannot deliver, returns, especially if you're keeping it in a long-term portfolio. And remember, if you're trying to use it for the short term, it can have losses also, capital losses, even up to 1 year. Balanced advantage, yes, to some extent, they do fit, but they are not substitutes simply because they swing wildly. Their unhedged portion, their high equity can be anything. So they are not going to do the job of doing the hedge or do the job of asset allocation for you. So please keep that in mind. The idea in all our portfolio building and portfolio allocation is to kind of contain downside. In India, we have seen that containing downside helps deliver, build wealth over the long term, right? And Aarti has made an extremely pertinent point that, we should be open to looking at other asset classes, the simple FDs. See, at Prime Investor, our deposits have quite a few FDs with attractive rates that are also reasonably safe. We have mixed them with prime portfolios simply because we think, in some cases you do need FDs. We were not, mutual fund only kind of, we don't have that thought process, and there is more reason why you could look at some of the more attractive ones. And two, our bond coverage, we will take a thorough relook. We have been very selectively giving bonds, and we were among possibly the first in the country kind of trying to create awareness about SDLs and G6 for retail investors using the RBI direct retail platform. And I would urge you again, especially for those income earners, etc., and those wanting capital safety. Now, with this kind and in this current environment, those make for great products. So please open an account there and look out, for specific bond calls that we will also learn how to and when to, kind of issue them so that the return and the risk are kind of balanced and even, given that, it has become a level playing field as far as tax is concerned. We will take a look at how we will go about, giving those calls. And NPS is a very interesting idea, Aarti. I do think that for debt, we have always advocated that people can look at NPS rather than for equity. And now there is a stronger case because you could do anything with it during your earning years and not get taxed. And only at the end of it, you get 60% tax free, at least as of now. So that makes for, a product that you should definitely look at, especially if you're in the high tax bracket. So, I would think that that kind of summarizes what we have said. And I think we will move on to the many, many questions that we have. But before that, and I'll remind you guys once again, while the government is all set to remove the, 20% indexation, we want to give the benefit of indexation 20 coupon code for all our investors. I mean, for all our potential, subscribers. So do go use the coupon code indexation 20, available only up to March 31st to, get the benefit of a Prime Investor subscription. By now, you will know what you can expect from us, and you will know the kind of calls that we will give, unbiased, and we are not worried about whether we are going to give less mutual funds or more mutual fund calls. We will be worried about what is optimal for you and what makes sense for you at this point in time when the tax laws are changing. So with that, I think I'll move on to the questions that we have here. I think there have been a number of questions, and many of you have asked about hybrid mutual funds and whether these will start looking more attractive. I think we have already kind of answered that, but I would like to add a point here on using a hybrid mutual funds. Please remember, mutual funds are allowed to only have the hybrid aggressive or the balanced category and not both, right? So some mutual funds may probably give up on some of their funds and convert them to balanced. When I say balanced, that will be the category that will fit this 35% over 35% to 65%, this middle thing that the taxman now allows for indexation. So it's possible that some mutual funds will do it, or many of them will do it. I think I already saw some announcement by Quant Dynamic. I mean, I think the dynamic asset allocation very clearly states that there will be now an equity-oriented, kind of mutual fund. So there will be many funds doing that, but there again, please take it with a pinch of salt with hybrid mutual funds. Please see what is the objective. Are you trying to do asset allocation? Is this fund going to fill the space of a debt fund? If it's not, if it's a long-term portfolio, yes, some substitute for the sake of tax allocation is fine, but not all. So I'm going to go to more questions that are, coming our way. I'll just read a couple of them and then have some of you kind of, talking to us. So we have here, is it a good idea to fill up international funds, gold ETF and debt funds before 31st March and forget it? Equities I can invest after April 1st. Probably, Aarti, would you like to take that?
Whether you should fill up, as you say, all three, I'm not too sure. I mean, I'm sure most investors work to a preset asset allocation plan. So if you've decided on, say, a 60% allocation to equity, say, for 30% to debt and 10% to gold, and you've not actually completed this allocation, whatever surplus cash you have, you can definitely put it there. But I would not urge anybody to try and sell their or redeem their existing holdings or sell any of their existing holdings and do this, because the time that you will take to get the money in your account and redeploy also may not be enough, I feel. So if you today, if you ask me what offers good investment options, definitely I feel long duration debt funds like constant maturity debt funds, etc., 10-year, they offer good opportunity because rates are still at 7.3, 7.4 in that category, and there is scope for good returns from here if you lock in. Target maturity funds also 2027 maturity kind of products are attractive. Gold has risen a bit recently on the turmoil, etc. But the need for a gold allocation has become very, very evident recently with these banking crises still unfolding globally, and we are not fans of Bitcoin, etc. So we think gold is the alternative safe haven. But usually it's not a great idea to buy gold when it's already rising so sharply. But we do advocate a 5 to 10% allocation in your portfolio as a kind of counterbalance to your equity investments. So international equity, actually, US equity is the only kind of funds that we have found merit in. And timing wise, I mean, you will have to wait for a specific calls on this in order to make your allocation.
Right, thanks, Aarti. Now, possibly this question will be for Bhavna. There's a question, Bhavna, which asks, what should be, how should we treat a debt as far as our asset allocation goes now, and whether
continue to treat debt as debt in your asset allocation. So, like we said, no, you don't change your asset allocation just because the taxation on debt mutual funds is changed. You will have to get, you will have to get a lot more active in your debt investments. That is true because of the changes. But debt as a whole is not, it is necessary in your portfolio. So you don't have to go to debt funds, that is there. You can use, especially these FDs of small finance banks, where it's very attractive, especially now You can use, like Aarti said, the bonds, NCDs, and you can use, the corporate bond funds. You can use these constant maturity funds, all of them. So when you talk about debt in a portfolio, it's not only debt mutual funds. It is multiple products that fall under debt in terms of asset allocation. So you still have to follow that equity debt split based on your time frame and your risk and all of that. But you don't have to stick only to debt mutual funds. You can use a combination. You can use active profit booking. You can use, like I said, you can exit NCDs and all of that to get more returns. So the tax rule, and also, if I'm not sure whether this was there from the beginning, I mean, the listener was there from the beginning, but like you said, no, Vidya, the increase in tax outgo because of the change in debt taxation, is not prohibitively high.
Right.
I mean, unless you switch the tax slab, it's not so high that it negates all investment in debt funds. So you need to approach it from that angle and not just be terrified that there is debt and therefore there is tax and therefore it should be invested.
Right. Thanks, Bhavna. So there were also another question on multi-asset funds. So Bhavna, you also want to take that? What's the taxation there on multi-asset?
What was that?
Taxation on multi-asset funds.
Okay, multi-asset funds. So multi-asset funds, see, by their what do you call it? By their mandate, what they might say is they go 0 to 100% equity, 0 to 100% debt, blah blah. But based on where taxation is going now, I think they are going to stick to at least 35% in equity. Even if you look at the current multi-asset allocation funds, their equity allocation is generally more than 35% only. None of them are like 20%, 10% and all that in equity. So even without this, even without the change in the tax rule, they tend to be only in the long term is more than 3 years with indexation benefits. They were anyway under that category. They will continue to be taxed like that because even, like I said, even if they say they are going to go 0% to equity, no fund has gone to 0% in equity. They will make sure that they will stay, at least I think they will make sure that they will stay above 35% in equity. And by their own thing, they usually don't go that low. I mean, they may be low equity, but a lot of them actually stay more than 65% in equity, even in multi-asset allocation funds. So it goes entirely to what they have, but they will definitely not be in that less than 35% equity short-term capital gain rule. So,
right. Yes. We have one more question here. One person asking earlier, SWPs made more sense than depending on FD income. Now that will no longer be the case. I don't think that's nothing changes with SWPs. Please remember SWPs. I mean, obviously the long term or short term, that impact will be there. But unlike FDs, if you take say 10,000 of interest income from FDs, the entire 10,000 is taxed. With SWP, if you take a withdrawal of 10,000, only the capital gain component in it is taxed. So to that extent, SWPs will always remain attractive compared with regular income earning from interest. And please remember, in the early years, the taxation is also low simply because the principal component of your SWP is high. I mean, if you put today and start withdrawing from next month, the growth in your mutual fund is so low, so much of what you are withdrawing is your own principal, right? And therefore, it's important to understand that SWP remains a very desired form of, at least one of the forms of income generation. The others could be G6, the others could be SDLs. These all pay out interest, and they could be great, forms, especially if one locks in now. They can also be very good ways to earn income. We have one more question. Aarti, perhaps you could take this. People may try to invest a lot in target maturity funds. Can that impact the YTM a lot, since AMCs will have extra money to invest suddenly or keep it as cash?
I don't know whether that quantum of inflows will really come in within the short period, because we are assuming everybody is sitting on truckloads of cash just waiting to deploy, because this came as such a googly, right? If it had been announced in the budget and people had had a lot of time also, people may have redeemed money and kept it ready. But since this came as such a sudden thing, I doubt if the inflows will be of the magnitude that they will cause such disruptions. This is also because target maturity funds, as far as I know, most of them focus on either GSECs, I mean central government securities, and that too from liquid tenors like 5 years and 10 years, or they focus on the most liquid SDLs. So I don't think that the inflows can be so big that suddenly there'll be a excess demand problem for these, and then the yields will, I mean, I don't think the yields will fall, etc. So I feel that worry is a bit overdone. But I think the decision on how much to put in target maturity should be based on whether your goals really match with the maturity date of the target maturity. If you just want a long-term allocation, we prefer that you invest in constant maturity funds, because there are 10-year and 5-year options available now. So if you want to just play the rate cycle, and the fact that we may be close to a top in the rate cycle, I feel constant maturity funds may make more sense.
Right. There's another question of what is the alternative to investing in international funds. I don't think, like Bhavna mentioned earlier, the other asset classes, gold, international investing, there are no substitutes for it, right? They are there for a specific purpose. I mean, you invest in gold because it's a asset class that behaves differently, and it can provide to some extent, a hedge when equity is not doing well. And international investing, especially investing in the US, where we have traditionally had low correlation, it essentially means that, and they have demonstrated that they perform when we don't, right? And that's the reason why we are having it. So I don't think none of these reasons get negated simply because there is tax. I guess, most of you listening here, perhaps this is the time, whether, the budget that changes came in terms of new tax, old tax regime, or whether, what happened to property, slowly, it's not very attractive to hold multiple properties, or what's happening now. It is important for you to take a step back and take a relook at your investment strategy. In our own experience dealing with thousands of investors, majority of the investors think that tax basically should be the deciding factor for investments, and I think that's a very flawed approach to investing, and the taxman will increasingly prove that it will be very hard for you to do that kind of an approach. So please remove that approach of looking at tax-based investing. I mean, you can't put, for example, why were very poor insurance products, some of the poor, endowment policies sold? Why did they sell so well? Simply because, they gave tax breaks. So these kind of giving tax breaks, giving very high tax efficiency, yes, they are important, but looking at returns is equally important. If an international market can still deliver well, there is no reason for any investor to kind of stay away from that market. So please keep that in mind. So I don't think there are alternatives, and I don't think you need to take alternatives. And if you have the money to do everything before March 31st, it's a very different thing. But I guess we can't do that. Essentially, we all have to be investing, and we have to be able to continue to invest in a tax efficient manner, and look at adding products like, we said, possibly to kind of ensure that you get better returns, not so much to escape tax, because that will be increasingly difficult. Arti, another question, can we replace debt portion of portfolio from debt mutual funds with bank FD? What's your thought?
See, today it looks as if bank FDs are good enough. They're fuss free. They give you fixed return. Why even have this complication of debt mutual fund? But I feel generally tracking rate cycles for a long time, I've noticed that bank FD rates tend to be very, very sticky. So when rates in the market go up, it takes quite a long time for bank FD rates to actually catch up. And if you want to be safe and stick with the systemically important banks, the big ones, you know, the SBIs and the PSU banks, etc., then those banks actually take an inordinately long time to revise their rates upwards. So for a long, actually, even today, if you see, the government of India is borrowing at rates that are higher than some of these big banks are actually offering on FDs, which is quite an anomaly. So I don't think a bank FD can substitute for debt mutual funds, because debt mutual funds, because they are invested into the bond markets tend to be very, very responsive to rate changes, either policy changes, and sometimes they even preempt it, etc. So if you want to quickly take advantage of rising rates, we will need to have debt mutual funds in our portfolio. And then there are these various variations in debt mutual funds, for example, credit risk funds, etc., where I feel the higher yield possibilities are there, and you don't have to. Whereas if you go to a individual corporate FD which offers that kind of yield, it will be quite a risky proposition. Or if you own a listed NCD which is rated just single A, it is quite a risky proposition. But when you take those calls through a mutual fund, you get the advantage of diversification. The other slightly underrated attribute is this anytime liquidity, you know, that debt funds offer. And now, because you don't have to keep checking your holding period and you don't have to hold your fund for 3 years, actually, this fact that invest in a debt mutual fund and redeem it anytime without a penalty, I think that will continue to be an attribute that will be valued. And on that score, it is scoring over FDs.
Right. And just to add to what Aarti said, if you go back and look at longer, return period of categories like medium duration, short duration, corporate bond, holding them over a longer period of time, a majority of the times they have been able to beat, FDs on a pre-tax basis as well. Right, it is only where in liquid or very short term money market, only the high rate scenarios help these funds give better returns once the yield moves up sufficiently. But if you go back, even gilt, right, if you are able to stay through the cycles, simply because fund managers are able to book profits on these, on capital appreciation, that is when the rate falls, that really adds heft to the NAV, and that is where the returns really come from. So on that note, I want to make a very important strategy change that even we might look at. See, at this point in time, even last week we gave calls on a series of attractive target maturity funds. Okay, and and they are all, we recommend hold to maturity and target maturity funds, which means if you lock into attractive coupon, I mean the yields now, you will get to enjoy those yields, give and take, the expense ratio and all that. But I think going forward, the real value add might start coming from the active debt funds as well, provided they are cost conscious. The corporate bond funds, the banking and PSU debt funds, even short duration funds to some extent, the medium duration funds, all of these will kind of, because they can manage not just the credit risk part, but also they are allowed to manage their duration part more actively than a TMF can. Their ability to return, especially in a no indexation scenario, might be higher. So I would think that you shouldn't, in the present run for TMFs, let's not lose sight of the fact that these funds have traditionally, especially we are still at a peak rate scenario, but when rates fall, they adequately make up. I know we have seen double-digit returns on those, which normalize over time and become single-digit, but still that may be sufficient to beat FD. That's the point that I'm making. So FDs are good. You should look at options that are giving attractive returns. Our prime deposits do have some of them, and our FD tool actually gives you the confidence that we have, and we have something called our confidence level in some of the bank FDs, which do offer attractive returns. But it's not like the sheen is gone off yet, especially in the categories that I just said. We do know for a fact that the pre-tax returns can be higher over the long term if managed well, of course, and very importantly, if funds become more expense ratio conscious, which they will necessarily have to. right? So on that note, I think can I need Gaurav to tell me this, my colleague Gaurav. Can I open up, if somebody wants to make some comments, we'll be happy to hear what others have to say. We have been talking for long. Can somebody, Gaurav, tell us how to go about doing that?
Absolutely. So if you have a question, please raise your hand and I will bring you up as a speaker.
Not only a question, even if somebody has a comment to make, we have listeners like Deepak Shenoy, Sandeep Parekh, and Subra here. So, any of you want to add to what we said or make a comment, you're welcome to do it.
Yes, please.
Hi, Aarti. Hi, Vidya. Hi, Bhavna. I know. Hi to you guys. I just wanted to make one comment. Thanks for the space. I think one of the things about FDs is that the accrual is taxed in your name. So, in people who keep FDs for a really long time but don't necessarily depend on that income, they are taxed perhaps in a way because they don't use the money that they receive, but they still are paid that money, or that money, even while it compounds, it accrues to you in terms of your tax return, and therefore you have to pay taxes on them. A debt mutual fund avoids that taxation accrual, and only replaces it with deferment of that entire tax towards the end, even if you consider that buying new debt funds after April 1st. And the second one was, I think you mentioned about gold and international funds. Is there an alternative? I think the alternative is to directly go buy the underlying products. Like for gold, you can buy actual gold, or you can buy a sovereign gold bond, which is a proxy, which is not affected by this rule. And for international stocks, you can actually do an LRS and create an international account and then directly buy international stocks from there. That also does not hit this rule. So that means any investments made directly into international stocks you will be able to get capital gains with indexation tax long term after 2 years. So that is another option in case people want it. Just wanted to put those points in. Thanks so much.
Thanks, Deepak. Those are very valuable ones. So, Deepak has made the point that your FD income, gets TDS is deducted automatically. So whether you want to, hold it for the long term or not, there is a cash outflow, and there is, a kind of a penalty. There's also a time value of money that is involved there because of your cash outflow. And with mutual funds, the saving grace is that you will not be taxed on accrual. You will be taxed only at the time of redemption. So it's a very valid point that he has made that talks in favor of course, holding mutual funds. And we also had actually one of questions that we had here on Twitter was about foreign stocks. Yes. For those of you who can kind of, you do need a little bit of deep pockets, but where you can, the taxation structure there is different with 24 months of, long term and less than 24 being short term. So that's an option if you are, kind of more market savvy, definitely. So on that note, are there any other people who'd like to give their comments? We'll be happy to hear them. We have Subramani here. How are you, sir? Are you there? Okay, I guess perhaps he's not there right now. Let's just go back to what other questions we have. Okay. Bhavna, there's one person here who asks, if I already hold, with the debt investments that we already have, which ones are worth keeping? So, what is your?
I think they are all worth keeping. So, if they are good funds, continue to keep invested in them. So, whether it's good or bad that we have an MF review tool, so you can put your fund in and get our call on whether it's a buy, hold, or sell. So if it's a buy or a hold, you can continue investing in it. This is not a reason for you to exit your funds just because you have a lot of them. So see whether they are good If they are good, please continue to hold, because at any point when you exit, you're still going to get the tax benefit. So you don't have to do it like today, tomorrow, day after tomorrow. So at the time when you are reviewing your portfolio or something, if you have to exit these funds, just exit them if they are not good performers, or if you're trying to rebalance or anything. But other than that, unless they are really bad funds, please don't try and unnecessarily exit and pay taxes and churn your portfolio for no reason.
Right. The other thing, quite a few investors spoke about arbitrage funds. See, yesterday, and Deepak and I had a spaces, and we had Radhika Gupta coming in briefly, and she herself expressed skepticism about the ability of arbitrage funds to take in that much inflows and be able to deliver. So please keep that in mind. This comes from an industry player itself. And it's possible, many of you may be tempted, because arbitrage funds at the end of the day don't have much volatility to so to speak, but do keep in mind that they are not return vehicles for the long term.
They don't have returns. So actually, if you take the returns, right, of arbitrage funds, is just less than 5%. So I mean, even if I take the longer term returns, so you're not going to get returns from arbitrage funds. So please don't look at it from that perspective.
Yeah.
Actually, I have a point to make, Vidya, like not about arbitrage funds, but about generally. Now, every time a tax change is announced, we sort of take it as a permanent thing, and then we go about arranging everything based on that change. But we should, I mean, if we just, for example, I have a substantial allocation to debt funds in my portfolio, and actually, if I just hold on to it, we don't know in future years what kind of changes may come about also. So, I mean, I feel we should give weight to tax changes, but not extraordinary weight, because if you start making drastic changes to your allocation, portfolio goals, etc., based on every tax change, with every new finance minister or government, you may have some new thinking on issues. So that is one thing. And secondly, this point that you made at the very beginning, first of all, you're going to pay this tax only if you redeem your funds, right? So this point that you made at the beginning, that unless you're jumping a slab because of this, the impact is going to be 3 to 4% or something. I mean, you will be calculating and presenting it, I'm sure. So should we just leave it be, and while redeeming, actually, you can just phase out your redemptions, right? If you plan to redeem a debt fund, just redeem it in tranches or something, and then you will be left with a smaller impact, and you don't have to fret about it so much.
Absolutely. So that's one of the things. Tax management becomes important here, rather than completely shunning an asset class or a product. I would think there are ways. I mean, and there are ways that the industry would adopt. Please remember, for example, funds use hedging. The hedging portion of the derivatives portion is considered as equity. So who knows? They might start, kind of introducing. They might be allowed to do that, to tweak their products, to make them qualify for long-term capital gains as well. So all these are within the realms of possibility. So I think we should focus on what's right for your goal and for your portfolio, for your risk profile, and how you can make optimal returns. So the returns will always take care of the pain of the tax outflow that one has to go through. Because otherwise, we have one person here asking us, would it be better to invest in money back policies or endowment policies than debt funds for the long term perspective, given taxation of debt? Right. So these are the kind of questions. We all know that they don't deliver well over the long term or the short term. I mean, over the short term, they're a big pain, but even over the long term, 4%, 5%, 6%. I mean, there are few products possibly crossing that realm, but there might be newer products that we need to relook at. For example, there might be many insurance products, say market-linked insurance products, say QLIP, that might introduce more of debt-oriented funds, right? And they will have a superior tax structure. And if they come with transparency, if they come with lower costs, why not? So these are the things at PrimeInvestor that we keep our mind open to ensure that we are focusing on products that a retail investor needs. Tax optimal, not tax free. Please remember, tax optimal. And if there is transparency in what a fund does, and if there is enough disclosure, transparency, enough information is available, we would naturally tend to move towards them. In the past 1 to 2 years, we are among the earliest to start giving the calls on the G6 and SDLs that were being auctioned for retail investors. We started giving very selective calls on privately placed bonds, so that people can with some risk appetite can, and with some corpus, can take advantage of the higher returns that those offer, and we will continue to search for newer opportunities. So on that note, you can kind of stay assured that we will be there to help you. And once again, before March 31st, indexation 20 is our coupon for you to get a good discount on our product, and possibly look at newer ways of investing, newer products, low cost products, and all of these recommendations in an unbiased manner. I think we come to the close of this session. We will be writing a detailed article coming week. Please read it. If you are here and you are not even registered to PrimeInvestor, you can register for free. You can have a trial, and you can also read this article when you're on a free trial. But please remember, the coupon indexation 20 is available only till March 31st. So do join us, and let's hope we can go through these times, taxes or no taxes. Let's focus on what's good for your portfolio and gain optimally. On that note, thanks all again, and have a good night. Thanks for joining us.
Yeah, thank you all.
Thanks, everyone. Bye.